Hi there, my name is Dan Page. I'm the president of Boulder Equity Partners. We are nationwide commercial real estate lenders. And today I'm here to talk to you about how to evaluate different commercial loan offers. If you're a borrower out there looking for cash for your business to use in your real estate, quite often you might go out to several different lenders. And I'm here to talk to you about how to evaluate those different loan offers and make the best decision for you. First, let's jump in some quick background about me. I've been in the commercial finance real estate industry over 30 years. I've closed well over $1 billion in transactions. I'm the go-to guy for thousands of commercial mortgage brokers. And I review at least 10, 15, sometimes more loan submissions on a daily basis. So it's not my first rodeo. First off, jumping right in, when you have a loan offer, really think about what are your needs. Because quite often most borrowers will look only to the interest rate. And sometimes that's the most important factor, but not always. Sometimes the best loan is not necessarily the one with the lowest interest rate. The best loan is really the one that gets you what you're looking for. So think about, why are you really looking for the funds? Are you buying an underperforming property that will be generating income down the road? Are you taking cash out to expand your business? Are you trying to pay down more expensive debt? Are you trying to lower monthly payments? Going through this thought process ahead of time is just absolutely crucial. So what are your options? Well, long-term loans will typically have the lowest interest rate, but sometimes they can be a challenge if you have things like bad credit, or if the property isn't necessarily stabilized, or if your debt service is too low, meaning there's not enough income to pay for that monthly loan payment. In those cases, and in others as well, you may need to look at higher interest short-term bridge loans in order to get your property and your particular scenario shored up, and then you can migrate into a long-term loan. So when are these short-term loans a better fit? It could be a fit if you have credit issues, your credit isn't perfect, you might have had a recent bankruptcy or some late mortgage payments or things like tax liens, or that might be a maturity default on the coming up for you. The property may not be quite income producing yet, or maybe not to a level that would be required for a long-term institutional loan. Or sometimes you just need to close the loan really quickly because you have an impending sale date, and bridge loans can close much faster. So the short-term interest rate isn't as crucial when you're comparing it to future income potential. And that's a wide and deep discussion. And I encourage you to call me if you have a scenario like that. But the crux of this is, once you get your property stabilized or able to achieve what it is you're trying to achieve, then you can refinance into a preferred rate, stabilized property, everything looks great. So the other advantage of short-term bridge loans is that you might have a higher interest rate, but it allows you that flexibility to do things like rehab, to pull cash out, or to perhaps buy another property that you're trying to buy right now and you need that money faster. You can get closed faster, you can generate income faster, and sometimes that low debt service coverage is not necessarily an issue, even if you're what's called upside down and there's not enough income coming in right now to service the loan. With a short-term bridge loan, quite often you can still make those types of loans work, where they wouldn't with a traditional long-term low-interest loan. So for example, we had a borrower that had a low-interest bank loan, very great rate, but she wanted to purchase a bunch more properties and was not able to pull the cash out that she needed. And I was able to work with her and actually get a little higher rate with a longer term amortization than the bank was willing to offer. So literally my interest rate, even though it was a little bit higher, her monthly payments were lower. So we refinanced her and at $2.5 million and pulled out a whole bunch of cash, and she was able to buy a lot more properties that she would never have been able to do with going back with a traditional bank loan. So when you're comparing competing loan offers, the whole point of it is to look what makes the best sense for you. Like I said a few minutes ago, interest alone doesn't necessarily tell the whole story. So you need to consider what you're really looking to accomplish and think long and hard about what that is. Run an investment analysis. ROI means return on investment, and the income potential, both the short term and the long term. If you go through that ahead of time, you might realize that what you thought you needed isn't necessarily what you need. So if you're going to go out to a bank or a credit union or a private lender like myself, think about all these things before you go out the door, rather than going in and spending a lot of time and a lot of money and running appraisals and all that. And really think about it and let the lender know what you want. Tell them your story. Tell them what you're really looking for, what your short-term goals and your long-term goals are, so that you can best match your loan request to the particular loan that you're looking for. So if you'd like to have more discussions, feel free to give us a call. We've been down this road hundreds, thousands of times before. We offer nationwide small business real estate loans, bridge loans, long-term loans, and we'd love to talk to you. So either give me a call at the phone number below, or you can go to our website, bolderequitypartners.com, and my email address is on there also. So thank you very much, and I look forward to talking soon.